So I have started to initiate some positions of Discovery to my portfolio after the share price declined recently. There's going to be a few components and assumptions to try to value Discovery, especially with the merger deal with WarnerMedia that's announced earlier this year. So in this video, I'm going to share with you just a few key points and rationale for initiating a position right now, and probably add more when its share price goes down further. For the benefit of everyone, understand that Discovery is a global media company. They provide content across multiple distribution platforms. Examples include pay TV, free-to-air, broadcast television, digital distribution arrangements, and direct-to-consumer subscription products. The direct-to-consumer channel is offered through its Discovery Plus video streaming platform launched recently, and this is also the company's forefront for growth and what many investors these days have been excited about to rival against industry leaders like Netflix and Disney. Discovery owns many great brands and franchises as seen from the chart here, including Discovery Channel, HGTV, Food Network, Animal Planet, Travel Channel, Motor Trend, and so on and so forth. As you may observe, the company is a market leader in unscripted content. Unscripted contents are shows that are produced without a script, for example, documentaries, talk shows, game shows, etc. All in all, the company distributes customized content in the US and over 220 other countries and territories in nearly 50 languages, serving an estimated 3.7 billion cumulative subscribers and viewers worldwide through networks that the company wholly or partially owns. Now we can see why Discovery's franchises are strong. The question will now be its valuation. Well, you can observe the climb in Discovery's share price to its peak earlier this year before it corrected sharply. This is due to the enthusiasm of its direct-to-consumer product, Discovery Plus, that led to many retail investors and funds jumping into the play and pump up its share price in the beginning of the year. Thereafter, the collapse of Archegos Capital caused a sell-off in Discovery and many other companies it has invested in. Since then, Discovery's share price has been in a downward trend generally. The announcement in May 2021 on a plan to merge Discovery and WarnerMedia had failed to stimulate the bull for its share price. The deal is expected to close in mid-June 2022 if federal review gives the green light to go ahead with the merger. So, in order to determine if investing in a company is a good idea, we need to evaluate Discovery as a standalone company and also make some assumptions and try to see what's going to happen to the new company formed from the merger of Discovery and WarnerMedia if the deal goes through eventually. So first, understand that about 65% of Discovery's revenue is generated from its US operation, while the remaining 35% is generated from its international segment. Overall, for fiscal year of 2020, the company saw a slight 4% decrease in revenue due to COVID-19 pandemic impact, circular declines in the pay TV ecosystem, which are partially offset by growth in its next generation platforms. Otherwise, I would say that Discovery's business remains strong, netting a profit when other businesses were adversely impacted. In fact, the company generated a strong free cash flow of $2.3 billion for the full year of 2020, albeit a noticeable decline from $3.1 billion in the previous year. With a free cash flow of $2.3 billion and a current market capitalization of around $18.5 billion, Discovery is trading at a very reasonable 8 times multiple to free cash flow. If the company's business reverts to 2019's level of $3.1 billion, the company will trade at an attractive 6 times multiples to free cash flow. Next, if we look at its balance sheet, we see that the companies hold about $15 billion worth of debt with $2.8 billion in cash and cash equivalents, meaning it has a net debt of approximately $12.2 billion. With its trailing 12 months EBITDA of $3.79 billion, net debt to EBITDA ratio will stand at around 3.2. This is a pretty healthy level compared to its industry peers. Now, look at the PE ratio chart for the past 5 years. Discovery's current price to trailing 12 months earnings has dropped back to the average level of around 17. This is a very reasonable, if not attractive, multiple to get into and right on the tailwind of growth in the video streaming and video on-demand subscription industry, which is growing rapidly. In fact, we are talking about a projected compounded annual growth rate of 12% in the video streaming market from now to 2027. Moving on to the merger deal, as discussed previously, the merger between WarnerMedia and Discovery is set to close in June 2022, subject to federal review. The new company will be called Warner Bros. Discovery. I will not go into the details of the structure, but from the chart here, you can see that Discovery shareholders will receive 29% ownership, while at&t, which is the parent of WarnerMedia, will receive 71% ownership of the new company. On a pro forma basis, the new company would yield $39 billion in revenue and $12 billion in adjusted EBITDA for 2020, with a projection in revenue to $52 billion and an adjusted EBITDA of $14 billion by the end of 2023. As of the second quarter of 2021, Discovery Plus had 17 million subscribers, while at&t's HBO Max had 67.5 million subscribers. Combined figure will work out to be 84.5 million subscribers. Observed from the chart here, the company's projected $15 billion of revenue to be coming from direct-to-consumer video-on-demand streaming segment by 2023. Since it will be a whole new package of films and programs contributed from both WarnerMedia and Discovery, the subscription plan should be based on a new pricing plan. Let's assume a $12 per month pricing plan at $15 billion annual revenue that will translate to about 104 million subscribers. This means that they have to grow their subscriber base at a compounded annual growth rate of about 9% for the coming 2.5 years. I think this target is quite achievable given both companies are already aggressively driving the growth in their subscriber base. Of course, one major concern will be the much higher debt leverage post-merger, with a pro forma debt to EBITDA of 5 times compared to just 3.2 times for a standalone Discovery. While both companies recognize this issue and have projected to deleverage to just 3 times 24 months post-closing of the merger, investors should continue to monitor, as there's many historical episodes of management unable to hit the projected target they set out to achieve. To sum it up, it is difficult to determine how the market will value the newly merged company, Warner Bros. Discovery, if the merger deal goes through eventually. But it does seem that based on the current bearish sentiment from Discovery's share price, it seems that the market is not so excited about the deal going through after all, and I think it provides an opportunity for investors to take up a position. Yes, perhaps the market is skeptical about the growth prospects and synergies between the two companies, as well as penalizing the share price due to the potential higher debt leverage. There's nothing wrong with that, especially with many failed stories of merger that happened in the recent past. Not to mention how at&t's acquisition of WarnerMedia was one such example, hence the spin-off now. However, personally, I think that these two media companies do seem to have more common grounds to leverage on each other. The merger will create a serious contender of both scripted and unscripted content in the video-on-demand streaming industry, and compete more effectively with market leaders like Netflix and Disney. With Discovery trading at 8 times multiple to free cash flow, it seems to me that we are paying for a stake in a great franchise but not paying for any potential growth in the future, whether it's a standalone company or a newly merged one. The downside seems to be limited, while the potential upside from the growth and multiple expansion looks promising. Hence, I have started to initiate some positions and perhaps will add more if the price corrects downwards further. Let me know your thoughts on this and share with us in the comment below, and consider subscribing to our channel if you think what I share with you today is useful. In the meantime, check out the recommended videos here to continue learning so that you can make better decisions. Keep learning, and I will see you next time.